With current market rates and prices at an all-time high, it's become increasingly difficult to find immediately profitable real estate investments. But it's not always just about the now when investing in real estate. I'm Brand the Mortgage Man, and I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. If you want to learn more about mortgages and real estate, please subscribe to my channel and leave a comment below about your personal experience if you're looking to buy investment properties. It's with my experience, I'm going to share why it's important to think long-term when it comes to real estate investments and how a break-even strategy today will create future profit. In this video, I'll discuss the current challenges many investors are facing in today's market, from higher rates and prices to market dynamics and the economic factors that affect real estate prices and demand. So let's talk about the break-even investment strategy. So what is that? A break-even investment strategy means that your carrying cost for the property is equal to what you bring in on that property, breaking even. So if it's the $3,000 cost per month to maintain your property and your rental income on that property is $3,000 a month, they wash each other out, meaning you're breaking even. So how do you calculate your total monthly costs versus the expected rental income? Well, what you want to look at are things such as your mortgage payment. You want to look at maintenance on that property, property taxes, homeowners insurance. Maybe you have to hire a management company to actually manage the property for you, right? These are all things you want to consider as far as carrying costs. You may even need to consider utilities depending on your lease agreement, because your tenant may not be responsible for those things depending on how you write things up. But you want to make sure you consider all of those expenses, and then you want to look at your monthly gross rent, the amount you're actually renting the property out for. When you're running the numbers initially to determine if you can at least have a break-even scenario, make sure you're considering all those things so that you can determine whether or not the market rent for that property can support covering everything. Now, what are the pros and cons of a break-even strategy? Well, the pros are, you're still getting the appreciation in the property's value. Like I've talked about in other videos, even if the property's appreciating at 5% per year, you're earning that appreciation, right? On a $500,000 property, we're talking about a $25,000 year one appreciation on that property. A con? Well, that would be if market rents decrease and you were breaking even before. Well, now you're losing money on a monthly basis if the market rents decline, right? So you want to keep those things in mind, both pros and cons to everything, especially in trying to utilize a break-even strategy on that. Now, we talked about the appreciation being a huge pro. Well, what is appreciation, right? We talked about home values increasing over time. So one of the factors is just homes do appreciate over time. Real estate appreciates in value year after year after year. Pretty much in any market. The only time we saw home values come down was during the Great Recession, right? 2008 to 2011-ish. But that recession was caused by the housing market, right? There were people getting mortgages that they couldn't really afford. They were losing those homes. It was driving down everyone's home prices because there were so many foreclosures and short sales in the market. That's not normal. Hopefully that's the only time we'll ever see that in our lifetimes, right? But in any normal market, home values appreciate. Now, you have appreciation just naturally, and then you also have appreciation in home values based on demand for the properties. So I've talked about when interest rates come down, home prices typically increase because the demand for the properties goes up and the supply of those properties, in most cases, stays the same or only increases slightly. Definitely increases less than the demand. And when there's more demand for something, the value of that something goes up because there's more people vowing for the exact same thing. So if there's more people trying to get one thing, well, that one thing could go for more money because that seller of the property is going to have a seller for more. So you have appreciation through general appreciation and value over time, and then you have appreciation based on the market and what's happening in the general market with property values, interest rates, and demand for properties. Now, what are the long-term benefits of owning a property? Well, you want to look at the projected potential future value of this break-even strategy. So we talked about break-even strategy today, but you want to keep in mind that over time, your rental amount on that property is going to increase. On average, the rent increases nationally are 3% annually, right? So we're saying that if you property rented for $1,000 a month, it would rent for $1,030 a month next year, using that 3% per year annual increase in rent, which is going to have a direct impact on your cash flow of that property. Because if you can try to keep your expenses in line from year one forward, and you can incrementally increase the amount of rent you're collecting on that property, well, you're slowly but surely going to start to profit and you're no longer in a break-even scenario. Now, another thing you want to consider is that you'll be able to refinance at some point in the future, right? We talked about rates being at an all-time high, and you're breaking even based on that higher interest rate and the resulting payment for that higher interest rate. But when rates eventually come down, you can take advantage of that and refinance. Refinancing means you're going to pay off your existing mortgage with a new mortgage. And the plan in this case would be a mortgage at a lower interest rate. And that would drive your mortgage payment down, freeing up more money for you to make on a monthly basis, giving you a positive cash flow, and you're no longer breaking even. So you want to keep that in mind as well. Equity growth is actually something that you want to consider long-term as well, right? We talked about the equity growth and how it affects the property values, but another thing it affects is the refinance, because the lower your loan to value, right? You have more equity in your property, meaning the value is higher than what you owe on the mortgage. The more room there is between what's owed and what the value is, the better terms you're going to be able to get on that mortgage when the time comes to refinance. Now, let's look at a 10-year investment projection using a 3% annual rent increase. And we started off with a break-even strategy. So I want you to look at this table on the screen now, and you can see from year 1 through year 10 exactly what's going to happen. Breaking even in year 1, and slowly but surely as time progresses, you're becoming profitable on that rental property, where by the time you get to year 10, you're looking at positive rent on that property of almost $17,000 per year. So what was once a break-even strategy where you weren't making any money on the rent itself, you're now making nearly $17,000 per year in positive rent on that same home that was initially bought in a break-even situation. So as you can see, if you're willing and able to think long-term with your real estate investments, you will have an easier time finding those that will generate a return in today's market. If you found this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.